Today we have Chapter 10, Flexible Budgets and Performance Analysis. And what we're going to be talking about today is we'll be expanding on the idea of budgets and talking more about control. Specifically, how do you check to see if the company is in line to perform the way you outlined in the budget? And there's a key problem that we run into, and it's the idea that budgets are inflexible, that a budget is made based on the assumption that you're going to make and sell a certain number of units. And reality doesn't always turn out that way. So how can you adjust your budget to reflect the reality that you might have produced and sold more or fewer units than you had originally budgeted for? So we have the idea of the variance analysis cycle. And by variance analysis, what I mean is we're going to compare the budget to actual results. And the difference between budget and actual is what we call the variance. And so we're going to start off by preparing what's called a performance report, which does these comparisons. It compares your budget to your actual performance. And the difference between those will be what we call a variance. We're going to analyze those variances, raise questions, and look for the root causes, take whatever action is necessary in order to address the root causes, go through another period, whether it's a month or a quarter or a year, and then do another performance report. So you have continuous improvement built into variance analysis. And we're always concerned about it's a dangerous thing in budgeting to think that if something increases profits, it's favorable, and if it decreases profits, it's unfavorable. And in fact, that's what we're going to do when we do our budgets. We'll show if it increases profits, we'll write a little F, showing favorable. If it decreases profits, then we'll show a little U, unfavorable. That's really only the beginning of the story, because what we really want to do is we want to understand what caused the variance and address that issue. Because sometimes there might be an unfavorable variance that the reason for that unfavorable variance is actually a very good reason, and it may either be something you have no control over, or it may be something that in fact is in the best interest of the company. So we have to always go into variance analysis with an open mind and consider what our mission is and how we want to accomplish it. So learning objective 1 is to prepare a flexible budget. And the idea of a flexible budget is to get past the idea that get past the point with a typical budget, which we covered in Chapter 9, which is designed only for one scenario. In other words, the entire budget was premised on a certain level of sales and production. Whereas you started off with your sales forecast, and then you created a budget forecast of a production forecast, and everything is built on that. And reality never turns out the way you plan. So there's this inherent problem in budgeting in that budgets are set up for a single scenario. And if the results turn out a little bit different, so if you assume that you're going to sell 100,000 units at $100 each, and you actually sell 110,000 units or 90,000 units, then it's almost impossible to compare your actual results to your budget, because you don't know if the variances were caused by the difference in sales or some other problem. And so what we want to do is we want to be able to focus down on the root causes and identify different reasons for things. And in order to do that, we need to create what's called a flexible budget, or the way I like to say it, we need to flex the budget. So the inherent problem here is that performance evaluation is very difficult when actual activity differs from the plan level. And so comparing a static planning budget from Chapter 9 based on a certain level of sales, let's say, to actual results where sales were different, you're comparing apples and oranges, and then you really have a big problem. So we're going to create what's called a flexible budget, or the way I like to say it, we're going to flex our budget. And a flexible budget is something we can prepare for any level of activity in a certain range. And they'll show how sales and costs would change based on the change in that level of activity. And these will allow you to control costs. It'll improve performance evaluations. We're not going to look at Larry's lawn service. I'm sorry to disappoint you, but rather we're going to look at the example in the book. So my planning budget is based on 1,000 units, and I have certain information based on all my analysis of cost activity. So I know, for example, that my sales price is expected to be $880 a unit, and if I'm going to have 1,000, this is a hairstyling, so they have client visits. So if they charge $1,000 if they have 1,000 visits for $180 each, that means that revenues would come up to be $180,000. Wages are fixed and variable. $65,000 is fixed per month, and $37 is variable based on the number of visits. So your wages and salaries would be $65,000 times 37 times the number of visits, 1,000. And that should be plus 37 times 1,000. There we go. Hairstyling supplies would be $1.50 times the number of budgeted visits. Client gratuities would be 4.1 times the number of client visits. Electricity would be 1,500 fixed plus 0.1 times the number of client visits. And I don't quite have Excel. My Excel skills are a little weak today. That's 1,600. Rent is 28,500 fixed. Liability insurance is 2,800 fixed. Employee health insurance is 21,000 fixed. And miscellaneous is 1,200 fixed plus 20 cents times the number of visits, 1,000, or 1,400. So your total expense would be $163,200, and your net operating income you could budget to be $16,800. So what I've done here is I've set up formulas based on my experience. We've talked a lot about how to do this, and now I can create a whole income statement assuming 1,000 visits. And then what happens is, this was my budget going in, and it's what's called a flexible budget because I've built in all of my knowledge of fixed and variable cost in order to calculate the budget. And you'll see later on I can change the number of visits. So in reality, I had 1,100 visits, and this is what really happens right here, and this is given to you in the book. So what you would want to do is you'd want to compare this reality to your planning budget, and you're going to have problems. So I can simply copy and paste everything down. And this is my planning budget from before, and calculate the variances. So the variance will be, and this happens to be how the book does it, so I'm going to follow the format in the book. I think in my book I do it a little bit differently. I think in my book what I did was I portrayed favorable variances as positive and unfavorable variances as negative. But what they do is they show all variances as positive, and they indicate favorable, unfavorable with an F or a U. So for example, revenue is higher, so this would be favorable, and they put in an F. Wages and supplies would be 106,900 minus 102, or 4,900. Hairstyling supplies would be 1,620 minus 1,500, or 4,900. So expenses were higher, that would be unfavorable. Client gratuities were higher, 2,770, so that would be unfavorable. Electricity was lower, so that would be favorable. Rent was the same. Liability insurance was the same. Employee health insurance was a little higher, so that would be unfavorable. And miscellaneous was higher, so that would be unfavorable. And then total expense, you can't add these up because they're all made to be positive, so you're confounding plus and minus items. So all you can do is just take the difference in expense here, and you get 9770. expenses were $9,770 higher, and net operating income was $4,430 higher, so that's going to be favorable. So this is how the book would have you do it. I think I would set it up a little bit differently, but anyway, this is how they're saying to do it. And so what you can see here is you can see that there are differences, but there's two different things going on. Okay, there's one fundamental fact that's messing up this entire equation, and that's the fact that not only did your expenses changed, but you sold 100. You had 100 more actual client visits than you were planning. You were planning on 1,000 client visits. You had 1,100. So naturally, of course, your income is going to be higher. Big surprise, right? So what you want to do is you want to see if you can adjust your budget to take into account the reality of what should have happened if you had sold 1,100 units, and then what actually happened. So with a flexible budget, it can be prepared, as I said before, for any activity level in the relevant range, and it helps you control costs. We're not going to look at Larry's lawn service again, lucky for us. But the basic problem here is that the static budget can't be compared to actual if it's based on a different number of units. So we want to know, like this guy is thinking, I love this clip art. How much of the cost variances are due to higher activity and how much are due to cost control? We don't know. And that's why we have to flex the budget to the actual activity level. So we're going to need to know how total variable costs change in proportion to activity, and that fixed costs remain the same. And that's me explaining this on the board as I've done. I love this clip art. Where'd they find this clip art of the guy with, they probably like added the lines and stuff. Anyway, we're not going to prepare Larry, but let's prepare a flexible budget right now. So I go right here, and my budgeted client visits are 1,100. And revenue, I know to be 1,100 times 180. And I know wages and salaries, 65,000 plus 37 times 1,100. And I could go all the way down through this, but I like to be efficient. So I've already placed these into the formulas based on 1,000, and I can just cut and paste this formula right here. And now I get the same budget flexed for 1,100 visits instead of 1,000 visits. And now this is more comparable to the actual results of 1,100 than the static budget of 1,000 units, right? Because now you're comparing apples to apples. Learning objective 2 is to prepare a report showing activity variances. And what activity variances are the difference between your planning budget, which in this case was 1,000 units, and your flexible budget, 1,100 units. And this is what we would expect to happen if you make an extra 100 units, or whatever the change in activity is going to be. So for example, we have here, for Rick's hairstyling, we have activity variances, and our flexible budget, we had calculated way back here. Let's go back to the flexible budget for a moment. The flexible budget I calculated here, I'm just going to copy the whole thing. You know where I got that from? And then I'm going to go back to my planning budget, which was way back when. There, so this is what was supposed to happen with 1,000 units, and this was what should happen with 1,100 units based on my budget. So now let's see what kind of variances we would have. We would expect revenues to go up by $18,000, and that would be favorable. We would expect wages and salaries to go up by $3,700, and that would be favorable. We would expect hairstyling supplies to go up by $150, and that would be favorable. We would expect client gratuities to go up by $410, and that would be favorable. We would expect electricity to go up by $10, that would, I'm sorry, these would all be unfavorable. Expenses increasing are unfavorable. Rent is not going to change. And liability insurance is not going to change. Likewise, employee health insurance is not going to change because these three are all fixed. Miscellaneous would change. It would go up by $20 and that would be unfavorable. So in the end, my total expenses would go up $42.90 and that would be unfavorable. But net operating income would be $18,000 minus $42.90. It would increase by $13,710, which you would hope because you are selling more units. And so operating income would go up with $13,710, and that would be favorable. There you go, F, favorable. So this is what activity variances look like. And the basic idea is a very important idea to get, is that you would expect these things to happen if activity changed in this way. So if activity changed and you had 100 more client visits, then this is what you would expect to happen to the company. Very simple. Learning objective 3 is to prepare a report showing revenue and spending variances. So what the revenue and spending variance is about is the difference in revenue based on if you hold the number of units constant now. So you're working here with your flexible budget, not your planning budget, and you compare your flexible budget to the actual results. For revenue, you're going to have a revenue variance, and for your expenses, you're going to have what's called spending variances. And I'll demonstrate this in a very simple way again through the model of Rick's hairstyling. So we have here revenue and spending variance template. And here's my flexible budget with 1,100 units. And here's the actual results. So now I'm comparing apples to apples because I'm comparing the actual results with 1,100 visits to the flexible budget based on 1,100 visits. And now what would happen? Well, and again, we show all variances in this book as positive. So I have a $3,800 revenue variance, but it's unfavorable because revenue was lower than the flexible budget. I have wages and salaries increased by $1,200, so that's also unfavorable. I had hairstyling supplies. The actual was lower, so that would be favorable. We have client gratuities. I can't even figure out what that is. That's an expense? So they tip their clients? Right? Maybe it's that I don't know. I think what they do is they include the tips in revenue and then they give them out. This is where they give it to their employees or their independent contractors. I guess they're employees here. So anyway, client gratuities was higher, so that would be unfavorable. Electricity was lower, so that would be favorable. Rent was the same. Liability insurance was the same. Employee health insurance was higher, so that's going to be unfavorable. And miscellaneous was higher. This is then the flex budget, so that would be unfavorable. Total expenses were higher than the flex budget says they should have been, so that's $5,480 unfavorable, and therefore net operating income was lower than the flex budget indicated, and that would be unfavorable. So there's a very interesting story that's going on here. If we go back to the activity variances here, you could see that it's, of course, if you make another 100 units, then income, revenue, expenses, and income are all going to go up. That's nice, right? And that's what you would hope, Connie. The more you sell, the more money you make. But the revenue and spending variances is somewhat surprising. because it turns out that revenue is a little lower than it should be for 1,100 units. Wages and salaries is higher. This client gratuities, whatever it is a lot higher than expected, and so is employee health insurance. So your expenses are much higher than they should have been for 1,100 units, and therefore drove income lower than it should have been. So you would want to understand this really well, understand what this client gratuities item is, especially because it seems like the largest expense item, and try to figure, and why were your revenues down? Why were they lower than the flex budget, less than $180 each? It doesn't quite make sense. So you would want to investigate these things to see why. And usually there's a whole story to be told. Learning Objective 4 is to prepare a performance report that combines activity variances and revenue and spending variances. So basically we're going to put all this information together into a single report so that we can see the whole story on one page. So here's the basic information, and we have our actual results back here. And I've got my flexible budget. Should really do this by linking, but here it is. My flexible budget here, and my planning budget was way back in the beginning over here. So now I've got all the different budgets in one place, and I can begin to look at what the differences are. So I'm going to have my revenue and spending variances, remember, is between the actual results and the flexible budget. So for revenue, that would be 198 minus 194,200, and that was unfavorable because the actual was lower than the flexible budget. For wages and salaries, actual wages and salaries were higher for 1,200, so that was unfavorable. Hairstyling supplies were $30 lower than the flexible budget, so that would be favorable. Client gratuities were $67.80 minus $45.10. They were higher, that would be unfavorable. Electricity is $16.10 minus $15.50, or $60 lower than expected, and that would be favorable. Rent was the same. Liability insurance was the same. And employee health insurance, $22,600 minus $2,130, was $1,300 higher, is favorable. Miscellaneous was $2,130 higher, so it's going to be $710. That's unfavorable. And again, for the total expense, I'm going to look at the total of the actual minus the total of the flexible and not add the column up. So my total expenses, again, were $54.80 higher than expected, unfavorable. And therefore, my net operating income was $92.80 lower than the flexible budget, which is very unfavorable. Now let's look at the activity variances. Activity variances would be the difference between the flexible budget, this was the first one we went over, the flexible budget, which accounts for the 1,100 units, and the planning budget. So basically, these are the changes in figures we would expect if we had a change in activity. So if we had another 100 visits, what should have happened? So revenue should have gone up by $18,000. Wages and salaries should go up by $3,700. That would be unfavorable. And hairstyling supplies should go up by $150. That would be unfavorable. And client gratuities would go up by $410, also unfavorable. And electricity would go up by 10. That's unfavorable. No change in rent or liability insurance, or for that matter, employee health insurance, because those are fixed costs. And miscellaneous, we would expect to go up by 1,400, also unfavorable. So we would expect total expenses to increase by 4,290, and therefore we would expect total income to increase by $13,710. So there's a story here, and you really want to try to pull the story out of what you see. We had an additional 100 client visits, great. And as a result of that, income should have gone up by $30,510, and revenue should have gone up by $198,000, and expenses should have gone up by $167,490. So we would expect things to turn out like this. The way things actually turned out was like this. We only had $21,230 in income, and we only had $194,200 in revenue. So this is what should have happened, and this is what actually happened. So let's go back and try and understand it. Revenue, something happened here with revenue. Maybe they gave out some discounts, they paid a little extra wages and salaries, and there's a huge problem here with client gratuities. For some reason, client gratuities went way up, and we want to know why. Also, employee health insurance went up too, much higher than it should have gone. It should have been fixed. So we would look into the health insurance plan and find out what happened. So this would be the beginning of this investigation that you would want to do to understand what's going on in your business. And this is going to give you tremendous insights, because if you may either need to change your flexible budget, or you may need to change how some things happen in your business. And just a little side note, nonprofit organizations, these types of things are extremely important for nonprofit organizations, and they receive funding from a lot of different sources, and so they would rely, their variance reports would be especially important, and they would want to be able to look at how they spend money in a lot of different ways to assure that they have proper control. They're also done using cost centers. We've been talking about a profitable organization, net operating income, but you can do the same thing looking only at expenses and not on revenue and net operating income. In other words, a cost center would just have expenses, and you prepare one of these reports based on the total expenses, and then that's it, and not do anything about revenue and operating income. Learning Objective 5, prepare a flexible budget with more than one cost driver. This speaks to activity-based costing. You may have more than one cost driver than just the number of units, in our case, the number of client visits. So in that case, organizations are pretty complicated, and it may benefit you to have several different cost drivers. And if you use activity-based costing, then that would provide you with a tremendous advantage in coming up with a more accurate, flexible budget. So you can use all these different cost formulas you've developed under activity-based costing and come up with a better flexible budget. Let's go through an example of one. So again, we have Rick's hairstyling, and I've got cost drivers template. And the actual client visits is Q, and the actual hours of operation is H. I'm doing this slightly different from the book, because the book calls this Q1 and Q2. I don't know. I decided to use H for hours. So we have revenue would be 180 times Q, so 1,100 times 180, or $198,000. And expenses would be 65,000 plus 220 times H. So I just build these into my spreadsheet. Imagine what it was like in the old days when people had to do this by hand. So 1.5 times 1,100 is 1,650. Client gratuities is 410 times 1,100, or 4,510. Electricity is 390 plus 0.1 times Q plus 6 times the number of hours, or 1640. Rent is still fixed at 28,500. Liability insurance is fixed. Employee health insurance is fixed. Miscellaneous is 1,200 plus 0.2 times Q, or 1420. So the sum of the expenses is 168,620, and revenues minus expenses comes out to be 29,380. So what you can do is you can adjust the actual client visits, and you can adjust the actual hours of operation. Let's see what would happen if you adjusted hours of operation to 300. See? Back to 190 again. Back to 300. Back to 190. And you could do all sorts of things, but the most important thing is you can flex your budget to the actual client visits and the actual hours of operation and get a pretty accurate flexible budget this way.